Ajay Bagga into the discussion now. Ajay, thanks so much for coming down to our studios. First, a view on the markets, the sort of environment that it has become. I mean, the Nifty is at 11,600, but it feels that, there is, like a massive slowdown, and it just feels as if, things are just not moving.
Yeah, and the reality is it is a two-faced market. Most of the rise in the market is contributed by a few, stocks. And if you look at January 2018 to now, your mid-cap index is still about 23% of the highs. About 21,800, 21,900 index is around 17,000 still. So we have not really caught up to the kind of falls that we have seen in a very widely distributed sense. And second part is, Pankaj, most portfolios have not performed because it's not that everybody has loaded up on those 5-7 stocks and ridden the wave. If you look at the mutual funds also, nearly 76% of actively managed funds over the last 1 year have underperformed their benchmark. That is really showing that the growth is concentrated in a few particular stocks, and the wider market has underperformed.
So what should one do? Is it time to look into wider markets or, certain sectors within the wider market that are leaders within their space?
Yeah, we have to look at, I think it's a very different market in the sense that don't expect much of a fiscal stimulus. The government is left of center. It's not the usual BJP pro-market government, but it's a more soft socialist kind of a government into redistributive justice. So we have to look at sectors which will survive and thrive despite the government policies and which are not really dependent on the government policies. And I think that's what we'll be in for. The second big thing is second order effects of a very strong governance by this government. Leakages have got plugged. So the first order effects were demonetization, GST, money going out. You saw real estate collapsing, land values collapsing, a lot of business models which had stayed for centuries collapsing. Now, all that is out of the way. That's in the dustbin of history now. But what we have to look at is that with that liquidity not there to help the markets, which are the sectors which will still continue to perform? And in India, then the big story remains consumption. 66% of your GDP is consumption, no matter what the fund managers and all of us so-called experts say. The consumption is what will lead this economy higher. You can't ignore the consumption.
Right, but don't you think that's already also in the price, because the consumption sector has been underperforming? The companies have been talking about, the consumption space not, most of the companies, we spoke to Imami, we spoke to Dabur, all of them are talking about, things not looking that great, but stock prices are not falling.
They won't fall also, and I think we have been long enough in this market. You always get a premium to consumption in India. And this quarter, what will come out? You will see mid-single-digit sales growths, and you will see low double-digit profit growths. If you were watching the World Cup cricket, most of the ads were from home. It was the Googles, the Amazons, the Alexas, and all. I didn't see much of Levers or Colgate. Colgate, though, is totally out. Colgate, you don't see much advertisement at all. Even Nestle, very little. A little bit of Procter & Gamble. So people were conserving cash. Cost outs have been done. You will see a better profit line, but not a very good top line. That's what the market is going with. And slowly this turns around. Over the next 6 months, 12 months, the 3 RBI rate cuts, hopefully another rate cut in August, as they get transmitted over a 9 to 12 months period, you will see that coming back.
Okay, so, while in fact we're on the topic of rate sensitives, Pankaj, you were also looking at some of Siddharth Lal's commentary on the auto space. Let's just actually run through some of that and talk a little bit more about some of those auto names.
So, when I ran through that entire shareholder letter that they have written, it's a 3-page letter that they have written. And, when that letter, you just look at some of the concerns, they're saying that auto industry is definitely going through a slowdown. There's no doubt about it. But within that, they have done well in terms of launches, but they have also been impacted. But on the future, they are believing that a stronger player will emerge much stronger going ahead as the industry recovers. And for that, they plan more launches, and they are pretty sure that the fundamentals of the company are strong, and as and when the tide turns, they would be able to grow. So would that be the way to invest into companies which have great market share, time and again proven themselves with new launches, with new product categories changing with time? Is that the way that you would approach the sector?
Absolutely.
I'm talking about auto plus FMCG.
Yes. So auto also is your consumption theme, and again in auto, what we have really faced is a near perfect storm. A lot of things, BS6, the axle load limits being increased in trucks. We are seeing truck fleets being used 2/3 now with the excess capacity that came in overnight. Anybody in the government shoots off their mouth that we will have electrical vehicles as of yesterday. You don't change tooling and factories overnight. I mean, there are 300 vendors who are supplying into an engine, and you come and say, okay, from tomorrow we'll get that. So who will benefit then? It will be the Chinese. People will import in the low value EVs, and your manufacturing will just get destroyed. That's not the way to approach it. You should grandfather a particular plan that, okay, over 5 years, we will have 25% vehicles as electrical. In 10 years, we would like 70%. We want to move towards that. The government's thinking is right. Solar and electric is the petchem of India.
Sure.
I don't want to, this month we got in $11 billion of crude imports. Why should we spend $120 billion and give it to the Arabs every year? Rather, build your solar plants, build your batteries and do. But it doesn't happen overnight. So, auto, good thing is it had a very good run. Now the shakeout is coming. The key players will come out stronger. So this is a good time to buy auto. It's a contrarian call. It looks as if this is the end. I remember, in one of your programs in 2015, Seth Klarman of Baupost had bought a lot of the oil producers, especially the nearly bust guys in the US shale space. When Mukesh Ambani was also buying there, if the smart investors were buying that, there would have been something in that. And look at how that sector turned. So, the money has to be made going contra-cyclical. Auto, right now, nobody wants to touch with a barge pole. Maybe this is the time. Maybe you have 3 to 6 months more.
If you take the example of oil, it's a completely cyclical sector. But don't you think auto is not that cyclical? I mean, it's also an element of consumption that it has. It also depends upon interest rate. It also depends upon how new launches are coming in.
Very true. And the best example for your argument I would give is the Japanese example. The Japanese auto numbers, they peaked out in 1995. And after
the auto growth numbers?
Yes.
Okay.
The peak auto numbers, auto production numbers.
Okay.
So after that, Japanese get it from all over the world. They started building factories because the demographics peaked. India, what are we talking? We're talking a very young nation. We are talking a very under-penetrated nation. We are not a developed market, so we have not reached peak auto. We are not Japan of 95. We are probably US of 1920 or 30. That's where we are at. Or China of 1992 is where we are at. We have another 15, 20 years to go. And within that, the auto guys will find. But yes, a lot of the players will get wiped out. That's a certainty. So it's good to stick with the top 1, 2 in each of the segments.
So would this theory hold true, like, sticking with the cream of the crop, even when it comes to NBFCs, because a lot of them have been battered. But today, in fact, we were having interesting discussions, and, Krishna Kumar was saying that, you can't look at the sector with a blanket view. There are select companies that have a strong model and that you can still look to bet on them. They've been unscathed by the overall crisis. You agree?
I would agree. And there, what I would say is where we have been blindsided has been quite a few well-run NBFCs are going on having successive accidents. So you see 100, 200 rupee fall in prices, then you get to know, Jagan Mohan Reddy is removing some contract somewhere and these guys are affected. You can't price for that, even as an analyst, and I'm sure the credit committees of those NBFCs would not have been able to. This is force majeure happening. But why should I pay for force majeure? So how do you plan against that? You go for the retail-focused ones. So I think NBFC story, wholesale is largely over in this country. We should, if you have it, then cut it and get out of it. Go into the retail guys and make sure they are not lending wholesale. The day they start lending wholesale, you have to drop them. Then you stay with the private sector banks, retail-focused ones, or private sector banks, even corporate-focused ones, which is the turnaround story of this year. You'll see very good returns. Public sector banks, you'll get 20% year-on-year returns. But where the market is, if an Allahabad or PNB says that Bhushan, who has taken us to the cleaners, was also fraudulent, the market hits them 10%. That was already baked into the NPA. You have taken a 53% provision, but the market says how much more is there, this, that. It is more a government strategy that you put a CBI case on the promoters, that they just don't run away only with a haircut, but they spend time in jail. But the market then disrupts. But I think the story this year will be top 4-5 PSU banks. Their turnaround, they will really give the Nifty earnings boost.
So that's exactly the point that I was coming. We've seen this, argument earlier as well in the last 5-7 years. Every time they come up, again, the argument comes. How do you approach, when you say top 4-5, make a basket, how should you approach these PSU names?
Yeah. See, again, when you're making the portfolio, ideally I would just buy the top 2, but, then you're afraid of accidents, of something else coming out. So in your allocation to PSU banks, I would say it's good to spread out the top 2-3, have the lion's share, and then have the next 2. The smaller ones will get merged in, there will be some value, but that you will have to take a trading call. But investment-wise, these 5 will come through. Remember, they have been losing market share. Of the 100 rupees of credit growth that we had last year, 44 came from private banks, where they have only, as per a stock, they have a 22-23% share. So they are doubling their share on an incremental basis. So you have to have the lion's share of financial allocation in private sector banks. They are eating market share. But the PSU is finally a turnaround story. And history is behind us. Valuations are good. 10 years they have not performed. So we'll not, I think the probability is high that we'll be right. As Pankaj is right, last 7 years, everybody's been wrong. We have been calling the NPA flattening for 5-7 years. But I think finally we have reached a stage.
Okay. Ajay, of course, is with us. Ajay, we're talking about the PSU banking names. What would you make of some of these non-funded, not fund-based, financials, maybe an insurance, an AMC company? How would you approach? The sector has also expanded.
Yes, very low penetration, only one way to go, which is up. So you have to own the insurers, you have to own the AMCs, and look at the pedigree again. So the market leaders, what is happening, especially in mutual funds, the top 8-10 guys are getting most of the AUM. It's very difficult for a new player to come in. A lot of foreign players have exited the market, and we are seeing more and more concentration of assets with the top players. So, good to own. Insurance, again, hugely underpenetrated, only will grow for multiple decades. A good time to get in and stick with these companies. You have both public sector and private sector insurers which are listed, can be looked at.
Okay. I just want to bring up Yes, because that's a big mover today. We're tracking earnings, but would there be anything you could see on a Yes Bank that make you look at it differently today, Ajay? We have also been tracking exclusively here on ET news of a fund infusion on a Yes Bank as well.
Yeah, I saw your coverage, and that's what I was thinking, seeing the price movement. Kunal can tell us, he can read the smoke signals that something's coming tomorrow. But probably, that's what the market is anticipating, the way it is moved. Otherwise, the news has been negative only, even the DHFL exposure and stuff. So we'll have to look at how much is the coverage now, and are we reaching a point where now they have a handle on any more skeletons in the cupboards. And secondly, somebody coming in because growth has to revive and they didn't have the growth capital.
Sure.
So we are expecting some PE announcement of some patient money coming in, which will help them, enable them to restart growth. And I think that's where the stock will get re-rated. Today, the price action is showing that. Probably you'll get the announcement very soon.
So Kunal, why don't you enlighten us? Anything on the charts at the current level?
No, so I think the big part of the move happened just in the last 1 hour. And when I was spotting the screen, the way the stock was moving up, it was purely based on short covering. And still a lot of shorts are still there into the stock price. It's not just that, with this 5%, 7% rise in the open interest today, it indicates that there is still a lot of shorts into the system on Yes Bank. And if this move just about, rises by another 4-5 rupees, then all those, round off strikes, 105, 110, 120 odd strikes, they would start to, cover their positions. If someone has written call options or has probably shorted futures at much higher levels, then the margin of safety or the buffer for these, traders could probably, go out. And that is where there would be a more hurry in terms of the price action. So today is the first day where you're seeing those signs. I think the stock just about holds on to this 100 mark and maybe stays at 104, 105, say over the next 1 or 2 days, there should be incremental amount of short covering, which should take the stock much more higher, even from current levels.
Right, but Ajay, also, the point that again Kunal was talking about, the sort of short covering. Do you think majority of these stocks which have seen such fall mainly will first be led by short covering, and the confidence build up may not happen only, in 1 or 2, in 1 or 2 quarter results?
Yeah, again, it will be qualitative. So there are some which have gone down, which will stay down, which are finished. So, what you saw in .com, we saw enough players which were 100 Ps at that time in 2000. And then 2003, the Infis, the Wipros stayed put. Satyam survived, but Satyam had an accident in 2008. So similarly, the infra construction guys, 2003 to 8, your pharma guys 5 years back, 6 years back, and all of us couldn't get enough of pharma last 3 years. Nobody wanted to touch pharma. Now probably it's bottoming out or near to the bottom.
Right.
So there'll be a lot of these stocks which will never come back. But yes, particularly I think given the new management and given a banking license in India is a very valuable tool to leverage. And if run well, you have seen enough cases like an HDFC Bank,
Right.
which you can.
Okay, Ajay, we'll let you go on that note. Appreciate your insights as always. Thanks much for joining in.